Good morning. It's Monday, June 23rd. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So the market's reaction to the U.S. strike on Iranian nuclear facilities has been muted so far, but much could change in the coming days. Traders are particularly focused on crude oil prices, the S&P 500, and whether shipping through the critical Straits of Hormuz will be affected. So checking out on the price action here, the S&P 500 and NASDAQ are both up slightly higher here in this morning's session, with Treasury yields also edging higher and WTI crude oil paring back its gains after that initial spike up to about $78.40. The market had come down and filled that gap on the session. You always want to pay attention to gaps on the charts as they become penetrated. Oftentimes there's a higher percentage and a higher likelihood that they will fill that gap. Also, you want to look at historical analysis suggesting that most of the geopolitical driven sell-offs in the stock market, they tend to be short-lived. So fading the crude oil rally seemed to be top of mind as many of the main producers were perceived to have the ability to increase supply in the event of a disruption. Also, closing the Straits of Hormuz would greatly impact many Asian countries such as South Korea, China, and Japan, which are Iran's three largest customers when it comes to buying the energy markets. So the real question is do they throttle down the flows, such as cut 50% of the flows moving through the Straits of Hormuz for the first month here, followed by another percentage decrease over the next 11 or even 18 months out? Under that particular scenario, you do get the triple-digit crude oil. I received many text messages and phone calls about they've shut down the Straits of Hormuz. Well, they didn't. They voted on it, and their parliament did, and they said that they were in favor of it, but the logistical nature of trying to get that done immediately takes a larger role and takes more thought process in order to do. It's also been estimated that a $12 geopolitical risk premium is tied already into the crude oil market. So does bombing Iran's nuclear facility reduce some of those risks here going forward? Now, you look at these markets here. Prior geopolitical risk events have led to quite a bit of volatility in, of course, oil and, of course, the U.S. equity markets and also the gold market. But in the looking at historical data, if you go to the S&P 500 and you go about 12 months past any of these big events here, we've seen the S&P 500 up about 9% on average. Now, I'm not telling you to go out and just buy immediately the dip once some nuclear facility has been bombed or something significant, but it's just something to know that many of the dip buyers out there, and we've seen this in the equity markets here recently, really since moving past many of Trump's tariffs, where the buy the dip mentality has been strong and has proven itself to be resilient. Now, will this time change? I don't know, but the levels to watch here, I would keep an eye on the S&P 500's low at 59.59. A break below this level on any kind of time frame could open up the gates for a retest of the 5,900. Now, a move back over 6,100 could really fuel this risk-on sentiment, short covering, and the FOMO of missing out on the next U.S. equity rally, and could push the market up to about 6,150. Many of the 12-month and year-end targets are closer to 63 and 6,500, and a lot of those banks are looking at that. Now, you look at the economy and some of the economic data coming out. We do have the flash PMIs for June. They're due out at about 8:45 a.m. Central Time, followed by existing home sales for May. Then we've got a number of Fed speakers coming out. Waller, Goolsbee, Williams, and Kugler all set to speak here. So gold, I had a lot of people asking about gold. I saw a lot of people rushing in to buy gold and things like that. We were checking the poly markets. We were checking everything else on where the prices of many of these different commodities were expected to be open. I had people asking me specifically about silver. Remember, silver is an industrial metal. You get war, you get things like that. You get uncertainty in the economy. There's less demand for that particular metal, and there's this flush for safe haven assets like the gold market. Now, this time around here, we saw gold futures gap higher and then continue to sell off, similar to what we're seeing in the crude oil, because gold, it does have a catch-22 where gold prices, they edge lower after that earlier advance, but sustained higher energy prices could spur inflation and make the Federal Reserve less likely to cut interest rates, really negatively impacting the gold market. You look at the ETF flows from Friday, and you can see that the exchange traded funds, they added about 556,000 troy ounces gold holdings in the previous session, bringing this year's net purchases to 7.08 million ounces, the biggest one-day increase since March 21st, and the 7th straight day of growth, the longest winning streak since April 21st. So we're also seeing total gold held by ETFs rising about 8.5% this year to 89.9 million ounces, the highest level since August 24, 2023. Now, they also added about 3 million ounces of silver, and that brings this year's net total purchases to 48.8. The ETFs increased their gold holdings by about 1 million. This is last week. They had to increase their silver holdings by about 5.8 million ounces. They're continuing to reduce those platinum holdings, and they're increasing palladium holdings. So gold, again, up 8.5%, silver up 6.8%, platinum just slightly higher. Gold-silver ratio sitting at about 93-1. The reality is that pricing in, these types of geopolitical events and the uncertainty that surrounds them is quite high. I noticed that the news flow became very inconsistent over the last few days. What you were hearing out of Iranian and Middle East news programs versus what you're hearing out of the U.S. were dramatically different. The types of weaponry that was used between the conflict between Israel and also Iran, becomes questionable, where you hear sirens come off, the markets sell off, and then it turns out they had only launched one ballistic missile towards Israel. So it was a lot that was intercepted immediately. So it just become very difficult. One of the standouts that I saw, and a lot of traders picking up Bitcoin futures on that dip below the 100,000 mark. Now futures at about 101,500. The low on the session was about 99,000. So we saw a lot of action there. Saw a lot of action in corn, in soybean oil, and then also in the sugar market in response to these are other energy related type of products. Now I'm going to be continuing to watch how copper prices trade because of this excessive heat that we have in the United States. You're seeing the grid really being strained. You also want to keep an eye on natural gas prices with that as well, because you're going to utilize that for cooling. The dollar index getting a big boost here on some of those safe haven flows with all the foreign currencies a bit lower. And then finally, you look back at some of these metals markets. You got platinum just a bit higher here, and you got U.S. equities flat. So really, it's just kind of a wait and see here. We'll see how the U.S. Open, on how that impacts it, some of the flows. But the buy the dip mentality on U.S. equities was there. The sell the rip mentality on the crude oil market, because the Straits of Hormuz is not shut down at the moment here, and much of the geopolitical risk and premium was already built into the market coming into it. So we're just going to want to continue to monitor and wait here. Remember, position sizing is key, risk management is key, trade your plan your trades, and everything else that I say over here. So you got any questions, give us a call or shoot us an email to info@bluelinefutures.com. And remember that futures and option trading, it does involve risk of loss. May not be suitable to all investors. Good luck, good trading.